All right. And if you are looking for Tax Tuesday, you are in the right place.
Good to be here.
You looking for Tax Tuesday?
I am.
All right. My name's Toby Mathis, and this is
Elliot Thomas.
And we're going to be your hosts today for Tax Tuesday, bringing tax knowledge to the masses, which is very fun. Hey, let us know where you're at in the world today, in the chat, if you can. Make sure that everybody out there is kicking. Hopefully you guys are having a great Tuesday and you're having a great week. It's the best week. Look at this from Maine and Arkansas, Denver, Oklahoma, Minneapolis, Cleveland, Chicago, San Francisco. Whoa, now they're going too fast. Vancouver, Washington, Honolulu. I'm jealous. Silicon Valley, Inflation Central, Dripping Springs, Glendora, Greenwich. Did I say that? Greenwich? Greenwich. Gosh, sorry. Greenwich, Lake Forest. We got people from all over the place. Midland, Texas. Thanks. James Woods. Isn't he famous? Anyway, so I'll just give you guys a what's up. All right, the sound effects are getting better. All right, so if you have questions today, we have a bunch of accountants. Let me see, we got Troy, Patty, Matthew, Jen, Jeffrey, Arash, Rachel, Jared, Tanya. We got a whole army of tax professionals to answer your questions. All you have to do is go into the Q&A and ask a question. If it's really detailed, like you're asking us to start doing basically work on your return, no, you have to become a client. But if you just have general questions, we're gonna like here's somebody just gave a book.
Yeah.
Let me
We'll give that one to Troy.
yeah, Troy, you can have that one. Troy with love. It's after the tax season. It is after tax season. Look at that. It's a week after tax season, so they're in recovery mode. But no, if he has general questions, we answer. And you can email them in when we are not doing the show, which is we do this every other week at taxtuesday@andersonadvisors.com.
Yep.
We're answering all those, right?
Yes, we are.
It's a lot of them, aren't there?
There are. Yep.
Yeah, and we just do that because we're crazy. We'll keep doing it until we sober up. But we like to just take out the hurdle of having to pay somebody and doing a bunch of other crazy stuff. It's easy for us to answer questions, easy for you to ask them. If this is your first Tax Tuesday, could you give me a thumbs up? Let me know this is their first Tax Tuesday out there. I know I can't, if we stream on YouTube, so not everybody can. There's a few. All right, you guys are there. So I'll give you a thumbs up.
Yeah,
welcome. This is your first one. This is just meant to have a little bit of fun and answer a bunch of questions. Elliot here picked a bunch of questions, right?
Yes, I did.
So I have to give him. He picks the questions this week. We don't know.
He says that now.
Yeah, when we read them, sometimes I'm like, were you drunk? Hopefully.
Just cough syrup.
Cough syrup.
And a lot of it.
A lot of NyQuil. Did I ever tell you my NyQuil story?
No.
Oh, it's a bad things happen. I took a NyQuil by accident instead of a DayQuil. And it was one of those things where I was talking and it was blah, 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 blah. And you're like, okay, you got this horrible cold. So going out to dinner. So I grabbed it. Didn't really register that it was one of the green pills and not one of the orange ones. And so I thought I'd trick everybody by having a vodka Red Bull.
Yeah.
I'll get a Red Bull. It'll wake me up because I'm starting to feel this dang NyQuil. Do not ever have a vodka with a NyQuil. That's your free advice. I was like, I remember waking up, my head against the wall at a stall in a bathroom.
I think the instructions say something about that too.
Yeah, don't do it unless you want to have an out of body experience. It was not good. That's not Tax Tuesday. That's just
Vegas.
That's just Vegas is about the most tame thing we have here. It's NyQuil. All I know is that it was a very interesting experience that I will not be doing again. All right, let's read the questions. We rented our house last year due to damages caused by the tenant and violations of the agreement. We evicted them. So they trashed your house. The tenant abandoned the property with their belongings. Of course, you really wanted those belongings. I really wanted those sacks full of whatever it was. All right, with proper judgment and the sheriff's help, we evicted them and cleaned the property. The tenant caused too much damage. Can we include the cost of fixing it on our taxes? Yeah, so we'll go over that. We'll give you all the rules and how and the good and the bad and the ugly, which was probably your home when these tenants got done with it. I've had a few of those tenants, so I can sympathize. I'm like, really? Really? This is what you did? This is
A lot of
who
hate.
raised you? Who raised you? I always want to go find them and scold them. Like, you didn't have to do that. I work from home. I already take deductions for my home office. Is there a repair, or if there is a repair in the house, like plumbing or an appliance repair, am I able to take a percentage of that repair off as a deduction? So we will answer those, and as well as these. In 2022, I bought and rented a rental property, but I never put the property on my tax return.
Oops.
Can I now add this property to my tax return and take advantage of the tax deductions, cost of ownership, etc.? Is there a limitation on how far back someone can amend a tax return or add a rental property purchased in the past? Great question. There's a couple of options, right? Always interesting when I get into these with tax people. My parents live in Singapore and are not U.S. citizens. They want to give me, my kids, 200 grand. Thanks, mom and dad. They have not previously gifted us any funds. Will any of us need to pay tax on this? Great question, and we'll answer that. Is there a different procedure to buy a residential multifamily with a pizzeria? Oh my God, I have to.
Pizza.
Yes, yes, we get pizza. Some of you guys know that we always use pizzerias in our examples here. So somehow you guys snuck it in, you get a star. They just get free services for life. All right, is there a different procedure to buy a multifamily with a pizzeria running downstairs?
Pizza time.
Oh my gosh, it's coming out there. We have our long-term rental properties with an LLC. How should we proceed with this? Can we do a cost segregation study and take bonus depreciation on this type of property and take advantage of the passive deductions? Somebody managed to sneak a pizza in. We'll answer that one too. All right,
No impact.
Just stop with the sound effects. All right, it's too much. Too much. All right, I got to read. What type of activities can I log toward rep status, real estate professional status, as a real estate agent? For example, working at home on my website, market research, advertising. Does having a home office mean my time driving to and from showings counts as time? Is education either required or optional? Great question. We're still getting some. People actually like the pizza. I like
Right.
pizza. If you like pizza, give me a thumbs up. This is how we know. I'm gonna test you guys. I'm from Philly.
Oh, get the heart.
Yeah,
too.
you're right. You gotta like your pizza. I'm out here in Vegas now, but I grew up in Philadelphia.
Not the same, huh?
Not the same out here. They always say this is New York pizza. It's like, no, New York's a long ways away, buddy.
This is from Henderson.
Yeah, this is Las Vegas pizza. It's desert pizza. There's coyote on that, I think. But what are the tax consequences if I sell a property in less than a year of purchase? Does the same apply to manufactured home? And would they be able to do a 1031 exchange if there's profit on the sale? So
Little twist there.
thank God I got you here to answer the questions, because I don't think I'd do so good today, right? Why should I open an S-Corp versus a C-Corp? So you just grabbed the most open-ended question. We can spend an hour on that.
We'll just hit the highlights.
We'll end at midnight. All right. Can you please explain the 100-hour material participation in detail? You participated in the activity for more than 100 hours during the tax year, and you participated at least as much as any other individual, including individuals who didn't own any interest in the activity for the year. So they're citing that, by the way. So that's actually one of the tests. For example, if I materially participated in my rental activity for 100 hours during a tax year, can I claim 100% tax deductions on my losses, expenses in my business activity under this test alone? Great question, and we will answer it. Speaking of answering stuff, hey, look, there's my YouTube channel.
Couple videos.
Yes, if you would please sign up. We're streaming this live right now. I think if you clicked on the live tab, you could absolutely jump on there. And but if you like the videos, I think I publish 2 or 3 a week, usually 3, sometimes 4, depending on how ambitious I'm feeling. And then I tend to be more focused on tax and financial planning. A lot more in the last few years on the financial planning because there's so much crap information out there. And I also feel really strongly that with the M2 money supply continuing to increase and the deficit of the United States being at $1.8 trillion, they're going to continue to print money, which means assets are going to go up for the foreseeable future. We're going to have bad inflation. So you really got to be investing. Otherwise, you're going to be behind the 8 ball and you're never going to be able to buy a new house, right? If you're Gen Xer, you're suffering right now, and this is the way out. Um, and then Clint, my partner for 20 something years, 25 years, does a channel that's almost exclusively on real estate asset protection. And so if you would sign up for both of those, and that way you'll get notified and put the little bell. I think you click a bell or something like that, subscribe and click the bell, and it'll let you know whenever there's a new video out. So that when new content comes out, you're notified and you're like, yay. And it doesn't go to your inbox. We don't pester you like that. It's just YouTube. Say, hey. Then if you want to learn how to use entities and how all the tax strategies that kind of go with real estate investing, just about every weekend, we teach a tax and asset protection. I do it. Brent Nagy, Amanda Winalda, Clint, myself, we all rotate around and we do these courses on how to use LLCs, land trust corporations, the tax ramifications, how to do legacy planning, living trusts, personal residence, privacy trusts, land trusts, Wyoming statutory trust, asset protection trust, the whole gamut. We do those. You can see right there that there's 2 1-day courses coming up. And then we also have our 3-day live in-person event. And I'm going to say 4 days because if you're a client, there's a 4th day if you want. Or you can just go to the 4th day, which is a client appreciation event. We're going to do a cocktail hour on the 7th after the 3rd day. We're all the folks that are going to do the 8th day. And then we're going to do networking. And we're going to do a bunch of joint exercises. We're going to learn about mission, value, vision, values in creating some targets and working through problems together and helping you guys create a little bit of a team to help you move forward. So that will be on December 8th. But that one's only available to clients. So you have to be a client to get notified. But if you want to do that one, I'm certain you can reach out in chat and say, hey, Patty, I'm curious about the 8th. Could I just go to that? Yes, you could do that.
Do they need to bring their NyQuil?
No,
Nope,
do not bring NyQuil. Do not bring NyQuil to the cocktail party. It would be fun.
There'd be stories.
It'd be stories. There'd be stories, and it's not true what they say about Vegas. It doesn't stay here. What happens in Vegas usually follows you home.
The courthouse.
Yep, smacks you over the head, and in some cases, re-aggravates every few months, whatever it is. All right. We rented our house last year. Due to damages caused by the tenant and violations of the agreement, we evicted them. They trashed your house. That's all you got to say. The tenant abandoned the property with their belongings. They got out while they could. With proper judgment and the sheriff's help, we evicted them and cleaned the property. The tenant caused too much damage. Can we include the cost of fixing it on our taxes? What do you say?
Quick answer, yes. A little bit more involved than that. We really have 2 categories, repairs or improvements. Repairs, Toby, I think, just did a video on this so he can go more in depth, but basically repairs are, as you think of, you're just kind of fixing it how it was. You're not really improving it or anything, making it better. It's just getting how it was before Elliot broke it or something like that. Improvements, and there we can deduct that immediately. No questions asked. That's an expense. Improvements, on the other hand, now we're adding a little more work to it. Maybe it's improving value or something like that, the lifespan of it, of that particular piece of property. There we're typically going to have to capitalize or depreciate over time. So you get a deduct it, but just not all at once, perhaps. There are a couple safe harbors. 2 off the top of my head, the $2,500 de minimis selection, which just says if that particular expense or cost, be it repair or not, or improvement, it was under $2,500 for that one item, then typically you can go ahead and just expense that. There's also the safe harbor maintenance. If it's something that you kind of repair several times over 10 years or something like that, there's another safe harbor there that will often allow you to go ahead and expense that as well.
Yeah, so when somebody trashes your house, it really comes down to, am I improving the property? Like, am I doing a complete restoration and bringing it back like new? Or am I just fixing the damage that they caused? If it's fixing the damage they caused, it's a repair. at the repaint, they trash the carpet. I'm just fixing it, right? So you're going to be more than likely just fine writing those things off as a repair expense. Where you get into issues is when you're bettering the property or doing a complete restoration, or if you're adapting it to something else. Those are actually technically the three tests. So did I better the property? No, I just fixed it. Did I adopt it to another use? No. I want to rent it and they trash the place. Did I do a complete restoration? No, I just fixed what they broke. And it was in, working condition before. Now it's in working condition again. It doesn't matter how much it is. I'm not worried about de minimis. I'm just fixing it. There's three safe harbors. There's routine maintenance, which I think you alluded to, which is if more than once during the useful life of the asset you're going to have to do that work, then that work becomes repair. So you have to figure out the useful life of whatever that item is. If it's the house, obviously the useful life is 27 and a half years on that case. I don't think we're able to do anything on that. But the other assets, the 15, the 5, and the 7-year property we're looking at, if you're having to swap it out every time you have a tenant and your tenants change out every 2 years, then that's going to be routine maintenance, and you're going to write off your carpet and things like that, period. And then the de minimis safe harbors, that 2,500.
Yep.
I will say this, that some of our clients qualify for the increase, which is 5,000. The 5,000 de minimis safe harbor just means if I spend on an invoice $5,000 or less, it's a repair. I make an election on my return and the IRS can't review it. It's done. It's a repair. In order to qualify for the 5,000, you just have to have financials that are kept not for tax purposes, but usually it's if you have a portfolio loan or something, you'll qualify for that higher level. But again, I'm looking at this and I think unless they trashed your walls and you ended up fixing your walls, and you just said, hey, you know what, these walls are already bad, so I just drywalled my whole place. And unless you did that, you're going to get to write it off as a repair. If you did that and you replaced it, uh, all the walls or just did a complete remodel, then I think you're safe. If you did do the complete remodel, then we're gonna have to be careful because chances are that's a complete restoration, and then that would be written off over its useful life. So I understand what they're asking. It's always this weird facts and circumstances thing, but you can, with a little bit of knowledge of just knowing those little nuances, you can make sure you don't misstep. Don't go too crazy. I work from home. I already take deductions for my home office. If there is a repair in the house, like plumbing or an appliance repair, am I able to take a percentage of that repair off as a deduction?
So as a general matter, yes. Home office, I always immediately jump to administrative office. Maybe we're doing a reimbursement. That's a different answer than a home office, though. And Toby pointed that out right before the show. I kind of always jump at that. But if we have a true home office, I got a sole proprietorship, and I'm taking a home office deduction, then as long as we use the actual costs and calculating that, then we could probably do a repair. If it was related to the whole house, yeah, we take a percentage. If the repair is related to the room itself, we might be able to take 100% if it's related directly to the office, and that would be your home office. There is a safe harbor on that home office, in which case we wouldn't be able to do any of that. The IRS just gives this arbitrary amount. I think it's $3 per square foot or five. It's one, two, five. Yeah, and it even maxes out, I think, at 1,500 total. So there we wouldn't be running into that. Yeah, very boo. But outside of that, administrative office, that kind of thing, being reimbursed for it, certainly percentage if it has to do with the overall house, yeah, we probably could throw that in there. And if it's directly related to the office, more than likely we can get 100%.
So let's say you have a home office and you're doing an administrative office in the home and it has a refrigerator in there. Like you have a little wet bar and you have to fix the wet bar. It broke, it started leaking. That wet bar and anything that's attached to it, so the electric and the plumbing that's attached to it, takes its useful life of 5 years or less. If you fix that, that's 100% deductible because it's part of that office. If it's your refrigerator in your house, just it's in your kitchen, and then it's a question of how much of that office as a portion of the total, and there's a bunch of different ways to do this. If it's an administrative office in the home and we're being reimbursed for like an S-Corp, C-Corp, LLC taxed as an S or a C Corp. If I'm getting reimbursed, it's a different equation, in which case we look at the net usable square footage of the house, or we use room methodology, whichever's best for you. And let's just say 20% of the house is being used as an administrative office, which isn't really 20% of the house, it's 20% of the rooms that are available in that house. Then you'd be able to write off 20%. You'd be reimbursing yourself up to that amount. You would add it all up and you'd reimburse yourself, and it's tax deductible to the company and it's non-taxable to you. So that's how it kind of works. Again, facts and circumstances. I hate to say it, but a lot of these things, it really matters as to, okay, are you a sole proprietorship? Are you a partnership? Are you an employee of an S-Corp or a C-Corp, or is it an LLC taxed? Is either of those the same difference? Those things actually matter, and they create a difference. And if you need us to point you in the right direction, I don't say this much on the Tax Tuesdays, but if you ever need us to, we do free consultations, guys, especially if you're on Tax Tuesday. Patty will share out, I think she has a link. I should actually have asked Patty. Patty, if you have a link, maybe just share it out with everybody. If you want someone to look and see if there's any way that we could help, or look at your situation, by all means, just get a consult. Just have one of the senior advisors, business advisors, take a look at it and see if there's anything that we could see that's low-lying fruit. Oh, there she goes. So yeah, there you go. Free consultation. There you go.
Can't beat that.
No, there. I guess if we paid you, technically. Yeah, let's talk taxes. Here's $1,000. It's kind of the same thing, because you guys we do something called Tax Saver Pro, which is a program along with the tax advisors, and they do a deep dive and tear up your tax returns. What's the, like, I just did the average. It was like $41,000 of tax, not of money, not tax deductions, but $41,000 of tax savings on average for the folks that they've done. There's probably 300 of those that we've done deep dive on. And that's pretty extraordinary. I was thinking it might be like $10,000 or something like that, but there's some that are huge.
Yeah.
And they kind of skew it, but but it's a really considerably high number of how much money, not tax deductions, but how much money in your pocket we're able to find. And that's per year, right?
Yeah, and if we don't find it, you get your money back. So it's really
Tax Saver Pro is like that.
It's pretty
But
easy.
same thing. Get a free consult. See if that's something that you're even interested in. If you think that you're probably overpaying taxes, my guess is you're probably right. Usually, if you have a hunch, you're like, gosh, you know what? It just feels like they're just taking such a huge piece. Have somebody look at it so that you're at least you know. Because I'll tell you guys a good story. I had he was a fighter pilot. He got into being an angel investor. So he was a grad of, I think it was West Point, and really high, like high energy. And he was an older guy when I sat down with him, but he was overpaying about $25,000 a year. He was making a considerable amount of money. You know who I'm talking about? And I looked at it, and it took me all about 3 seconds to figure out that he was like, why are you structured this way? You're going to end up paying over, like considerably. I just did loose calculation. I said it was about $25,000 a year. He goes, there's no way. My accountant's great. And we got the accountant on the phone and I asked him the same question. He goes, yeah, he probably could change. He probably could save that. And the client just lost his mind, like was turning purple. And he just said, why didn't you tell me? Like they've been 20 years, the accountant had been doing his taxes. And the accountant just said, well, you never asked. And that's a true story.
Yeah,
I was over McLeod. I was just sitting there going, holy cow.
They teach those pilots composure. I bet he was about ready to lose it. So
yeah, he was ready. Yeah, it was just kind of interesting. But I was like, hey, if he had taken it at any time to anybody that really knew what they were doing, someone like us, it would take us less than 10 minutes. You would have seen that. You would have said, fix that.
It sticks out.
Yeah, it was pretty obvious. So it's nothing magic. It's just either you know it or you don't. And sometimes like little things like that could end up putting a lot of money in your pocket. All right. In 2022, I bought and rented a rental property, but I never put the property on my tax return. We should.
There's always an oversight. I don't know if we have a button for that or not.
Oops. No, it happens. I've actually done that once. Can I now add this rental property to my tax return and take advantage of the tax deductions, cost of ownership, etc.? Is there a limitation on how far back someone can amend a tax return or add a rental property purchased in the past?
Yeah, quick answer again. Yes, you can. Is there a limit to how far back? Yes. I'll hit the limit first. 3 years from the date that you filed. Okay, so if we extended back in 22, that would give us all the way to what, October of 23, when we filed our return. You'd have 3 years from there to go back and get this. So that's our limitation time-wise. Going back to the first part of it, how do we take care of this? Well, it's interesting that this is 2022 and it's a rental. And if we actually were putting it in service there, because it was a first year that you put into service, you can go back and take bonus depreciation, do a cost seg and all that, and you don't have to do, it's not a change of accounting because you're picking, and now when you put it on your return, the initial depreciation. So it's kind of an interesting, almost works in your favor, but wouldn't advise doing this. But yes, you can go back and get that. And even if it hadn't been the first year, you could still go back and get it in there. Maybe we couldn't do the cost seg or change of accounting then, but here under this fact pattern, I think you're good. You'll be able to put it on there, return, catch up on the depreciation. And like I said, you could maybe even do 100% bonus depreciation being it was 2022.
Yeah, even if we found this out later, like we have folks that'll do this for 5, 6 years,
Yeah.
and then they're like, oh no, you could still catch up and grab all that depreciation that you should have taken and take it all in that year. And here's why you need to, because you may depreciate a property, but you must recapture that depreciation, whether you took it or not. Any amount that you were entitled to take, they will tax you on. So in this particular case, let's just say this individual did this for 10 years, and then they were like, oh, I never took any deductions. Well, the IRS is going to say, well, you could have taken $50,000 of deduction. Let's just use that as a hypothetical. You're going to pay us ordinary rate up to 25%, so up to 12,500. So not only did you not get the tax deduction, but you're going to have to pay tax on it. That's like a kick in the shin. Shin.
Exactly what I was thinking.
Yeah. Not pleasant. All right. My parents live in Singapore and are not US citizens. They want to give me, my kids, me and my kids, 200,000. Do you think it's me, my kids is both?
I think it's me and my kid and the kids,
All right.
family.
They have not previously gifted us any funds. Oh,
Yeah.
why'd you throw that in there? You just ruined it. I was
Making
just
up
thinking,
for it
yeah,
now.
they never gave us anything.
Christmas with light.
Right. Well, any of us need to, I'm just teasing you. Well, any of us need to pay tax on this.
So generally speaking, I don't know of a tax necessarily if you have non-resident, non-US citizens giving cash gifts over to their children or family. Even if there was in this situation, because I see parents, plural, two of them, they could each give 18,000 to all these people identified here. We have the person asking the question and kids, plural, two, at least two. So at worst case, at 18,000, 36,000 for each of them. That'd be over 100,000. You just do that right now, and then the first week of January, you'd fall under the 18,000 rule, so you'd be safe there. But I'm not aware of any tax necessarily of just giving the gift, the cash out front anyway. Although there are a lot of warnings about it. Maybe some people actually do it through their business, their international business, and give the gift. That could become taxable. They may think that was for some service. So a little warning there. You want to be aware of that and be careful.
Yeah, so non-US resident or non-US citizen giving money to a US resident or citizen. So first up, if you live in the United States, if you have a green card, if you're a citizen of the United States, you have to pay tax on your worldwide income, period. So no matter for the recipient, we don't care where you're located. If you're a US citizen or a resident, we don't care. But gifts are not taxable, period. Right. So there's inheritances sometimes could be taxable depending on the state you live in. I think there's like 5 or 6 states that still do some of that nonsense, but not under these circumstances. What I'm reasonably certain that the only thing you're gonna have to worry about is disclosure. And let me explain. The U.S. has no jurisdiction over non-U.S. citizens that are, giving something to a citizen, right? They don't really, they can't tax them because they're not here, right? There is no tax under those circumstances. If they were a US citizen or green card holder, they would have a amount that they can give, a unified credit amount that they can give during their lifetime. Right now, I think that's 13 million
Yep.
some odd.
Yep.
It's an extraordinarily high sum that you can gift away. We don't have to get into that because they're not here and they're not subject to US tax. So all we really have is disclosure. And I believe if you receive more than $100,000 from a non-US citizen, that you have a disclosure. I forget the form, but I believe that you have to disclose it. Basically say, hey, I got this. I'm sure Hunter did one. Uh, Probably not.
Oops.
Sorry. Just
Right there.
can't help it, right? But you're supposed to disclose and just say it. And then if they give you something that's foreign, so if it's a bank account, if it's property overseas, things like that, you may have what are called FBAR disclosures. So if it's over 10,000 bucks, you're going to have to disclose. Like for example, if they gave you $200,000 in a foreign bank account, then you have to disclose that every year on your taxes, or you're subject to penalty. What is that penalty? It could be up to half of the balance in that thing.
Mm.
It's pretty
Steep.
nasty. It's
Yep.
steep plus penalties and interest. So yeah, so if they're giving you money, even if it's not taxable, please be careful. Please let your tax preparer know. Because if that money is sitting in Singapore, for example, then we want to make sure that there's a disclosure. What's the
Yeah.
form for the FBAR?
I honestly don't remember.
You have to disclose it. It's not taxed. It's just the U.S. wants to know everything nowadays. Somebody was asking a question about the Corporate Transparency Act. They want to know. They're tracking real estate transactions that are done with cash. They're tracking who's the beneficial owner. Like it's just nuts right now. They just want to know everything about everybody if they can. What they do with that, I don't know. I think less disclosure is better. Oh, wait a second. There's the pizzeria. All right.
Yep.
Is there a, see if I got my things ready. No, I'm just kidding.
We're good to go.
Is there a different procedure to buy a residential multifamily with the pizzeria running downstairs? We have our long-term rental properties with LLC. How should we proceed with this? Can we do a cost segregation study and take bonus depreciation on this type of property and take advantage of passive deductions?
All right. So what I'm gathering here, and of course, there's different ways to look at this, but you have basically rental.
Pizza.
There you go. Residential rental upstairs. We got the pizza down below. That's probably commercial. You're probably renting that out, that commercial space. Your depreciation there is going to be over 39 years to begin with. That's kind of the starting spot. For the residential, that's going to be 27 and a half years. It's residential. So take the cost of it, divide by 27 and a half. That's your depreciation. For both, you can go ahead and do a cost segregation study, see if if it would be in your favor. Usually it is, and do bonus depreciation. And that's going to speed up. That's going to create a massive amount of deduction across the board for both of these. And then, yes, if you're not materially participating, if you're not real estate professional and materially participating in all this, those would be passive deductions, and you could offset against passive income. So maybe if you own the pizzeria as a passive investor or something like, you might be able to match those up. There are some different rules when you're on both sides of it. The rent, it's your building, and you're renting it as well. So we'd want to be careful of that. But generally speaking, yeah, you'd be able to take the bonus depreciation and use passive deductions, absent any passive deduction, passive loss limitations.
Yeah, there's one thing is if you own the pizzeria, so let's say you bought a residential multifamily and you're self-renting, you can actually group, and I should say potentially, because we have to look at it, say if it's basically the whole property or um, I think it's incidental. I forget the exact
Yeah,
test,
that's
but
it.
incidental,
Mhm.
then you could actually take the pizzeria and group it with the rental and actually use the rental losses against the pizzeria, even if you don't qualify as a real estate professional. So it's called a grouping election to treat it as one enterprise. And you could do that when you self-rent. If you don't self-rent, then you're going to be dealing with real estate professional active participation, depending on what your AGI is. You might be able to take some loss against your other income. Otherwise, it's going to be passive loss, and you can use it against your other passive income. But it doesn't change that much unless you're self-renting. If I just happen to have one that's doing commercial and maybe mixed use, it doesn't really change much of the equation.
No.
Although you can lump it all together. If you're renting a pizzeria and you have residential multifamily upstairs, it's still considered rental activity. You don't have to separate them out. You just have different depreciation schedules for the part of the building that's pizzeria versus part of the building that's multifamily.
I know the pizzeria didn't have any impact in getting the question here.
Pizza time.
Pizza time. Do I get free pizza? That's what I want to know. It's FinCEN form 114. Thank you, Benit and Troy, who said, hey, if you're doing FBAR, this is what you do. And it's fantastic. Look at these guys. They're just Johnny on the spot. We got a bunch of accountants out there, internally and externally. A bunch of you guys we always have the folks from the profession joining us. I don't know, because we're sick, I imagine.
Oh, I think we got Amanda on the YouTube.
Amanda's on the YouTube?
Yes, she is.
Amanda's on the YouTube.
So I don't think she's in our little list here.
All right. Hi, Amanda. Nice to not see you. No, she's great. What type of activities can I log towards rep status as a real estate agent? For example, working at home on my website, market research, advertising. Does having a home office mean my time driving to, from showings counts as time? Is education either required or optional? Great question. What say you?
Yeah, a lot of detail here. We're talking about rep, real estate professional status. Typically, that's going to have to do with our long-term rentals. That's what we're looking at. That's the world we're at here. The idea behind that is traditionally long-term rents are a passive activity. If you have a passive activity, likely you're going to have passive losses due to things like depreciation. And those losses can't be deducted anywhere again, except for against other passive income. One of the steps away from that is being a real estate professional. If you meet the criteria, then that turns it from passive to non-passive. What is the criteria? Well, properly for real estate professional status, if you spend over 750 hours in a particular trade or business that's real estate related, and they list out in the code 469C, 7C, I think it's about 11 different occupations, and real estate agent would be one of them. So you could be doing that if you owned that real estate agent business, or at least 5% of it, your hours would be counting towards your 750 hours that you have to get. Also has to be over 50% of your work week, basically. So all that in the real estate agent, if you're putting over 750 hours, this would work. And what kind of activities? Everything you list here, I think, would probably count. Market research, advertising, as long as it's directly related to you being a real estate agent, I think you're probably good there. Might be a little bit different if, let's say, you're a CEO and you want to put the time for cleaning and things like that. The IRS does have a little bit of a frown on that if it's something that's really not your position. But here you're running your own business, you're the real estate agent. So I would say anything related that will probably count, especially if you own the business, because you are the sole person running that. So I'm not too worried about that. As far as the drive time, that's always I love that question, because that's one of the most difficult ones when we're looking at this. To my knowledge, the only time we can use time is when you are another part of real estate professional, 750 hours, 50% of your work week. And then you have to also materially participate in managing your rental properties themselves. There, when you're going to manage your rental properties, I believe the time counts for driving if it's local. It doesn't mean you could fly across the country and count that travel time. But if it's local, I've seen some cases where I think they're going to count it. Here, you're not going for that material participation. You're going for the material participation in your real estate trader business. I'm not so sure if that time would count for commutes, but because you do have the administrative office or home office here, it does count for deductions and reimbursements if you have an accountable plan. As far as education, yeah, we can certainly deduct that, especially after the first year, I think continuing education, but the time doesn't count. Be very careful putting time spent for education into your hour count for rep status.
Yeah, it's easy. Like, I want to break it into two pieces. Piece number one, prong number one, is real estate professional. 750 hours, more than 50% of your personal service time. And it's and you materially participate in those businesses. So you're a real estate agent, as long as you own more than 5% of your real estate brokerage, wherever you're getting your paycheck, or maybe it's just you as a real estate agent, then you're going to qualify easy. You have to meet 750 hours and materially participate. The time that you commute, which isn't commute time, but if you're traveling between offices, so the time that you're driving to showings and back to your home office, that counts. But that's prong one. Prong two is, am I materially participating on my rental properties? And we aggregate them all together. Otherwise, it's per property. So let's say you have a bunch of rental time or rental properties, and let's say you have 5 of them. We're going to treat them all as one activity. Now we have an issue. Does the time that I'm traveling to showings count towards material participation there? No, it does not. Does education count towards that? No, it does not. Unless the activity you are doing is for your rental property. And from what I'm seeing, the real estate, you're not managing the properties. If you're managing the properties, there are cases where they let you count all of the time that you spent on the business if it was a business that was handling your rental activities. So let's say you were a property manager and you handled 20 of your own properties. And to be the property manager, you need some licensing. And it was part of your business, or maybe you did some other for some other folks. They would let you count all the time to keep your management license towards your material participation on your properties, if that was the case. But from what I'm seeing, that's not necessarily the case. So you'd be okay with prong one, real estate professional, and then did you materially participate, which is not a hard test to pass, right? It's 100 hours. So you're not going to need all the time, technically. You're just going to have to make sure that I am managing, I'm engaged in reviewing the leases, saying yay or nay, fixing the property, cleaning up the property, going down and actually working on it when you were looking for the property, acquiring the property. If I can add up all those hours, and if it's more than 100 hours or more than anybody else, then I meet the material participation test. So there's prong one, real estate professional; prong two, material participation on my rental properties. Aggregate them together, and then sometimes the time works on one and it doesn't work on the second prong. So I know it's confusing, guys. That's why you have to have professionals that know this stuff so that they're looking at you when you're telling them information, they're immediately saying, was it this or this or this? Okay, if it's this, then it's over here. If it's this or this, it's over here. Right? And don't try to get one over on anybody. Right? Just tell them the truth and then they'll help you and they'll be able to say, all right, here's where you're at, here's what you need to do so that we can make sure you're in the right spot. All right. What are the tax consequences if I sell a property in less than a year of purchase? Does the same apply to a manufactured home? And would they be able to do a 1031 exchange if there's a profit on the sale?
All right, looking at the first question here, tax consequences if you had it less than a year, we're going to need to know what was your intent when you purchased it. If you intended this as some kind of a flip, you buy it, maybe you fix it up a little bit and immediately sell, and that was the whole idea to get rid of it. That's going to have one aspect where we call that ordinary income, subject not just to income tax but also employment taxes. But what if it was the idea you're going to hold it for long term as a rental or something like that? Then that has a little bit of a different approach. And if you sold it in less than a year, typically that's going to be capital gains, but it's going to be short-term capital gains, which are taxed at your ordinary tax bracket rate. So no real benefit there other than it's not subject to employment tax like the flip was. Now we go on to our second question. What about manufactured homes? Then I'll hit the 1031. Manufactured homes, how they're going to play out in this is if you have to look at the state law, and usually if there's some kind of attachment, you've grounded it or something like that, the wheels are off, you've put on a cement base, they call that more of a permanent being affixed to the ground, and now you're looking at kind of like a regular rental. So now if you sold it, then you'll still have the short-term or long-term capital gains on it, or if it was a flip, that all stands still. But then could we do a 1031? We can't do 1031 with inventory or a flip property. When you flip, that's just inventory. So it would be no 1031 if we're under that branch. But if, again, it was a long-term hold, typically, yeah, you could do a 1031 as long as it's affixed to the ground. If it's not affixed to the ground, it's personal property, and personal property cannot do a 1030.
So the answer is less than a year, it's ordinary income unless it qualifies as an investment property, in which case then it would be qualified under a 1031, even if it was held less than 1 year. If you bought it with the intent to sell it, then it's going to be ordinary income as trade or business income, ineligible for 1031 exchange, subject to employment taxes. There, see, we made it
Got
easy.
it. There it is.
There it is. Boom. That's it. That's how it is. Not what everybody wants to hear. Hey, here's something that everybody should want to hear. Join us for the tax and asset protection workshops. We have 2 coming up, October 26th. Is that this weekend? Yeah, it is.
Yeah.
So join us this weekend. I guess I'm teaching it. Yes. And with Clint, and the November 2nd. And then we're doing the live event in Vegas, 3 days. Come to Las Vegas and hang out with us. You get to hang out with a bunch of not only us, because we're fun, but the other attendees are way more fun. There's usually, anywhere from 300 to 500 people that are investors and like-minded, and it's always kind of a kick in the pants to get to hang out with people that are doing the same things you're doing all over the country. How many of you guys have been to a live tax and asset protection event? Give me a thumbs up if you've been to a live tax and asset protection event, the 2-day, the 3-day live, or the 4-day live.
There they come.
A bunch of them. All right,
Yeah.
cool. So they're fun. Take my word for it. And then we're going to do one on December 8th for clients. If you're already a client, you'll get notified, which is more of a networking event. We're going to do some fun exercises together, and you're going to build up a bit of a team and be able to work with each other a lot more. Those are always fun. All right. Somebody says they've only been to virtual. You should come to the live one. Different. A, it's 3 days. B, it's in Vegas. So it's always fun stuff to do in Vegas. And you get to meet a whole bunch of people. Like, you're going to meet so many people, and everybody's really cool. I've always found that there's no bad people when you're around really good investors who are cool. They're just having fun. Everybody seems to be really good spirits. We have a lot of givers here. Like, that's one of the great things is this type of work. When people are successful, they tend to do nice things for other people, and it's fun to be around that. There's not a lot of desperate, kind of that weird energy that goes on when you're doing the get rich quick stuff. This tends to be people who are like, hey, I just want to make sure I have a legacy, and I want to protect the assets that I have, and I want to build it systematically, and these are the things I want to accomplish. Those are fun folks to hang out with. Nobody's trying to make $1 million off your back. All right. Should I open an S-Corp or a C-Corp? Could you make it? All right, you're just
killing me, Smalls.
Yeah.
Oh, could you do it any more open-ended?
Right. No, I anticipated this, but nonetheless, I thought it was a good question. Just hitting the rough basics, why would you do an S corporation? Well, you probably have ordinary income. We talked about that. If it's going to be taxed at your regular ordinary tax bracket rate plus employment tax, maybe with a sole proprietorship. So we put it in an S corporation where we can limit how much is subject to the employment tax. In the S corporation, you have 2 branches of income, one being your W-2 wage, you pay yourself a wage, and the other being a distribution, which is not subject to employment tax, wage would be. So we take a sole proprietorship, which is subject to 100% employment tax, put it in an S corporation. Theoretically, we could then cut that employment tax in half because only half of it, the reasonable wage, is subject to employment tax. Plus, it's in a corporation. That means we can do different deductions and reimbursements. We can do an accountable plan reimbursement. We can do corporate meetings under 280A, things like that, which will help lower all that, save you tax, get you cash back in your pocket, and it flows through to your return. You do file a separate return, 1120S. That's a flow-through entity, which means it just all comes onto your 1040 to be taxed. So that's why a lot of people like the S corporation. C corporation, on the other hand, similar in that it files its own return, an 1120, but it's not related to your 1040. It has absolutely no connection. You can have your money come in there. You could pay yourself a wage if you wanted to. Maybe you don't want to, but if you did, you could. And then you could, if you did get paid a wage, you could contribute to retirement plans. I guess you could do that for the S corporation as well. But a C corporation has the corporate meetings. It has the accountable plan like we just talked about for the S corporation, but it also has a medical reimbursement plan. So if medical is important to you, you might want to think C corporation because you can get those out-of-pocket medical expenses reimbursed to you. things that are very difficult to deduct, if not impossible on your 1040, if you're itemizing. So that's normally what we look at. Is it ordinary income? Do you have enough to justify a return, maybe 20, 30,000 or something like that, to get off your personal return? Lowers chance of audit too. And then you look at those reimbursements. If medical is an important issue, maybe C corporation. If you just rather have it flow through to your 1040, you're happy with the corporate meetings and things like that, then probably an S-Corp.
Yeah, I'll make it really simple. S-Corp flows onto your return. C-Corp pays tax at 21%. And if you want to pay yourself the profits at some point, you're going to pay long-term capital gains on that net. So if you're a high income person, chances are it's not going to change much. The big difference between the S-Corp and a C-Corp to me, and this accounts for LLCs taxed as S-Corps, LLCs taxed as C-Corp, is that a C-Corp, if you sell it, you could qualify as small business stock and you don't have to pay a tax on the first $10 million of capital gain if you sell a business that's a C Corp.
Yep.
As long as you held it for 5 years. There's a few, like if you're in architecture, health, legal, accounting, they don't let you do it. There's certain fields where they say you can't do it, but in just typical business, if you're going to sell your business, quite often we're going to start with a C Corp. Or because it's a flow through, if you're in a high tax bracket, we're probably going to look at a C Corp. If you have high medical expenses or a dependent that has more than $20,000 a year in medical expenses, we're probably going a C Corp. Even if we have to do a C Corp and an S Corp because there's a tax reason and a benefit by doing it that way. So why should I open an S Corp versus a C Corp? That's it. We try not to make it too complicated, but again, we could probably spend a day on that.
Yeah, you can go on.
Here's the differences. Here's how losses are treated. We could get into that, so here's how compensation is treated. Here's how benefits are treated. Here's the difference, all sorts of fun stuff.
Good time for a consult.
Yeah. And hey, if you're raising money, if you're going to have investors,
Mhm.
if you have other owners, then there's restrictions on who can be a shareholder of an S Corp, where that's not there for C Corps. So there's a number of considerations. It's just really sitting down and somebody says, how about a partnership? Stop it.
No.
Yeah. We you always take a look and you get a pretty good idea depending on what industries people are in, and you see the same thing. Like in real estate, it's pretty straightforward. If you're a realtor, you're going to be taxed as an S Corp, either going to be an LLC or an S Corp, depending on your state, and whether there's restrictions, whether you're a broker, whether you're just whether you're an agent. If you're going to build up a business, sell it, if you're going to have other shareholders, if you're raising money, all those things, you start narrowing things down pretty quickly. And it's just talking to somebody who doesn't. Does the 10 million gain from sales in a C Corp apply to LLC tax as a C Corp? Yes. And it does apply, and it works like a charm. And it's actually, that's the minimum. We've had folks, what, say, it was 42 million?
Yeah, I think it's 5 times, isn't it? Is it 4 times? 5 times the.
I forget the multiple, but it is. It's like 10 times the basis or 5 times basis. But we had a guy that he was 42 million, sold his business and managed to qualify. So it's always nice when you think you're going to be paying Uncle Sam, close to $10 million, you don't have to.
Yeah.
It's always like a
win.
day to celebrate. Yay, windfall. All right. Can you please explain the 100-hour material participation in detail? You participated in the activity for more than 100 hours during the tax year, and you participated at least as much as any other individual, including individuals who didn't own any interest in the activity for the year. For example, if I materially participated in my rental activity for 100 hours during the tax year, can I claim 100% tax deductions on losses, expenses in my business activity my business activity under this test alone? I'll let you answer, but I'm just going to say no. Doesn't work that way, but go ahead.
No, that's exactly right. Here we're talking about rental activity. We need to have real estate professional status. We have to have over 750 hours, more than 50% of our work week. And then we have to materially participate in our rental management of our properties as well. There we could, whenever we're using the material participation test, we could use the 100-hour test, but we got to reach all of those other statuses in order to be able to take this as a deduction. So strictly on this, no, you would not be able to. Now, if by rental you're a little confused and you meant short-term rental, and maybe you were materially participating in a short-term rental that you oversaw over 100 hours more than anybody else, the time they put in, then yes, it would. But with rental activity, that means long-term rental, and no, you would not.
Yeah. So remember we were talking about earlier, I talked about two prongs. There's prong one, real estate professional. Prong two is materially participate in your activity. You have to materially participate in your trade or business, but then you also have to materially participate in your rental activities. And the rental activity is like if you have a manager, a lot of people think it's 100 hours for the manager. No, it's the individuals that work for the manager. So even if you have a property manager and they have 2 or 3 people that work for them, maybe more, you're looking at down to those saying, are any of those folks doing more than 100 hours? That's your big fight. You need to get up to 100 hours and we combine spouse time. So this is not the same as prong one, which has to be met by one spouse. Prong two, material participation on your rental activities is both spouses together. So you could each do 50 hours and meet the 100-hour test. And then you're looking for anybody else, any other individual. Does any other individual spend 100 hours? If not, no. But that doesn't mean that you get to ignore prong one. Prong one's at 750 hours and 50% of your personal service. You still have to meet that. And whenever we're talking about material participation, we're talking about like when you're doing short-term rental loophole, this is the same test. You have to materially participate in your Airbnb if you want to make the loss non-passive. Otherwise, it's just a passive activity. What's a great example of a
Pizza
passive
time.
There
activity?
it is, pizza.
It's we open up a pizza shop. Elliot flips the pies. I do nothing other than eat the pizzas and cash my checks.
Yep.
I'm passive. I do not materially participate. Oops, grabbing my mic. I do not materially participate, which means I'm passive. Flipping the pies, materially participates, he's active. So I could actually take my passive, let's say I'm getting passive income and I have passive losses from my real estate. Guess what? I don't have to be a real estate professional. I can literally use those passive losses against my income made from my passive activity as a pizza owner, which is why a lot of wealthy people invest passively in multiple businesses that are creating income because they may not be a real estate professional, but they have real estate losses. And they're saying, hey, I have an appetite for this other type of income because I don't have to pay tax on it. So every time I get a distribution from our pizza shop, I know it's not going to be taxable because I have all this real estate that's kicking me all these passive losses and I get to use it. That's how these folks think. If you want to learn more about stuff like that, join my YouTube channel. I think Patty shared out the link before. She'll probably do it again. If you're not a subscriber, please subscribe. It helps with the algorithms and gets that information spread out to more individuals. And then you'll also get notified. And we do this Tax Tuesday live on the YouTube. I think we have more people on YouTube right now than we do on the Zoom. So like there's a lot of folks that go to the YouTube channel and watch it there. And then they're dealing with Amanda, which hopefully she's not getting smushed too hard because I'm looking at our guys and we have, let's see, Matthew, Jen, Patty, Arash, Jared, Jeff, Rachel, and Tanya all answering questions. And we're still 14 open questions. We'll get to them. Do not worry. We'll make sure that we answer your questions. And then just to give you a little bit more to think about, feel free to join Clint Coon's YouTube channel as well. He puts stuff out a couple times, a few times a week on real estate asset protection. He's very good at breaking that down and making it understandable. So if you want to know all that fun stuff about LLCs, land trust, living trust, corporations, Wyoming statutory trust, how it all works, feel free. These are free, absolutely free. And no, you don't get bugged. And of course, we already asked you twice to join us for the tax and asset protection workshop. This will be third time as a charm. Join us when you can. We love to have all of our folks, especially our clients, go in at least once a year, go in and get a refresher on how these things work and how the structures work and how they can benefit you. All right. If you have questions the next 2 weeks, which we will be back in 2 weeks, go ahead and email them to Tax Tuesday at Anderson Advisors. Know that Elliot here picks those, like you may get picked.
And I read them all.
Yeah, he goes through them and he picks them out. There's probably several hundred that come in every couple weeks. So if you have questions and you want to see if you get it read on the air, go ahead and do it. And then if you have any other questions or you want to visit Anderson Advisors, just go to andersonadvisors.com. If you would like a consult, we do free consults for you folks that come to Tax Tuesday. And free consult is a tax and asset protection consult. So they look at your entire thing. And you may say, but I only have tax questions. Let's look at the whole thing. You don't know what you don't know. Let's take a look. We break it down in pieces. We've been doing this for 27 years. We've learned a few things, and we follow a process. We do the risk reduction formula. We create a blueprint. We're looking for specific things that you might be leaving on the side of the roads that we can get you back and get you some better benefits. And it's absolutely free. So you can feel free to jump out there. I think Patty just put that into the chat too. ABA link tax assets. If you just, again, you want to just have somebody take a look, even if your structure looks tight, like you're like, man, I've got the best tax people, best legal, have somebody just give it fresh eyeballs. And if they say, yeah, that looks great, now you know. If they say, hey, you could try this, maybe there's something that could benefit you that they didn't see. The only reason is because I'm always seeing stuff that a lot of really great people miss. And you're like, oh, I miss stuff. That's why I ask these guys to review so much of my stuff. I'm always looking at it going, am I missing something here? And it's great when somebody says no. It's even greater when somebody says yes, because then I can learn something. And I appreciate that. I like to learn something. All right, guys. That is it for Tax Tuesday. There are still a bunch of open questions. So why don't we give all of the folks answering the questions? So Patty, Matthew, Jen, Jeff, Arash, Jared, Rachel, and Tanya. Could you guys give them a big heart? Yeah, they don't get to talk. They're basically they're images on my computer, and they answer a lot of questions, and some of them are really hard. Like these are not easy questions. Oh yeah. Like here's an easy one. Terry can't. Oh, actually, I shouldn't say the name. No, I'm not going to say it. Pooh, I just said it out loud. I always like. I'll just do that. If you use a portfolio loan from Schwab, from investments to buy rentals, is that interest deductible with the rental or investment expenses? It's from the rental. If you're using it for the rental, you get to write it off on your Schedule E, on your rental expenses, which is always fun. See. Thanks, Troy, for selecting that one. But those are the types of questions that are sitting there in the question and answer that they're answering all day long. And it's a lot of fun. So I'm going to say bye. You want to say bye?
Goodbye.
And we're going to mute ourselves and let everybody else answer questions. And so we'll end the Tax Tuesday this way. We'll keep it open for those of you who have open questions. Keep sticking through. They will answer your questions. And then we will end formally when the last question is answered. Thanks, guys, and we'll see you in 2 weeks.